Welcome to the Deep Dive, where we cut through the noise of corporate earnings calls to bring you the most important nuggets of knowledge and insight. Think of us as your shortcut to being truly well-informed, with surprising facts and just enough context to keep you hooked. Today we're taking a deep dive to JAKKS Pacific's Q2 2025 earnings call. It wrapped up July 24th. And this quarter presented a really compelling story, a fascinating mix of management's strategic resilience, battling some pretty significant market headwinds. The result? A decidedly cautious reaction from investors.
Right. Our mission on this deep dive is really to extract those key takeaways, give you the bigger picture so you can quickly grasp what's truly driving this company and, its sector. We'll dissect the numbers, explore the strategic pivots, and understand what this all means for the broader toy and costume industry, which is in a truly dynamic environment right now.
So let's jump right into the headline numbers for JAKKS Pacific's second quarter. The market's overall sentiment around this report was, complex, to say the least, but it certainly leaned towards caution. On the profitability front, the company reported an adjusted EPS of 0.03 cents. Now that actually sailed past consensus estimates by about $0.20, which is, a strong beat on adjusted earnings.
Yeah, that's a key point. But despite that profitability beat, the top line told a different story. Revenue came in at $119.1 million, missing consensus by approximately $5.0 million. And this represents a significant year-over-year decrease, nearly 20%.
20%, wow.
So while they beat on the bottom line, that top-line performance clearly raised some eyebrows.
Okay. Despite that revenue dip, though, there was a bright spot in their gross margin. It showed impressive resilience. It actually increased 80 basis points year over year, climbing to 32.8%.
That is a key indicator of their ability to manage costs, even with sales pressure. Looking at other core metrics, adjusted EBITDA was $2.3 million. That's a steep drop from $12.3 million in the prior year. And this particular metric, it strips out non-cash expenses, gives us a clearer picture of their core operational cash-generating ability. It really shows how significantly tariffs are biting into their everyday business.
Right.
The company also posted an operating loss of $2.8 million compared to a profit of $7.6 million previously.
Okay.
So yes, definitely a mixed bag of results that certainly got the market's attention.
All right, let's unpack this further and see where these numbers are coming from. Breaking it down by segment, the Toys and Consumer Products division experienced a 23.1% decline in sales, dropped to $80.4 million. The costume segment also saw a decrease, though maybe a more modest one, down 12.1% to $38.7 million.
Still down, though.
Still down. But here's where the geographic breakdown presents a fascinating contrast. The U.S. market was a significant drag on overall performance. Sales down a steep 30.9% to $87.0 million.
Yeah, that's huge.
That's a huge drop, and it really paints a picture of the domestic challenges.
Absolutely. And what's truly insightful here is the stark contrast with their rest of world segment. That demonstrated robust growth, increasing by 40.9% to $32.1 million.
40.9%.
Yeah. And this included Europe growing by an impressive 65% in the first half of the year. So this isn't just a silver lining, it's like a fundamental strategic shift. It makes them less dependent on a single turbulent market. Shows JAKKS is actively re-architecting its business model for a globalized, or at least a highly tariff-fragmented world.
Okay, and the company was very direct about the primary challenge they're facing, right? They explicitly stated that sales in the quarter were negatively impacted by a dramatic increase in the cost of doing business in the United States, all due to tariff fluctuations and, general uncertainty. This created hesitancy with many U.S. customers and, critically, led to missed commercial opportunities, especially impacting the direct import or FOB portion of their business.
Right. And just to clarify for you listening, FOB stands for free on board.
Yeah.
It means the buyer, so JAKKS customers here, assumes responsibility for the goods once they ship from the factory. So when tariffs spike, that direct cost gets passed straight to those customers, making them understandably hesitant.
Makes sense.
Connecting this to the bigger picture, the company's proactive and diversified approach to manufacturing is crucial for navigating these headwinds. While China remains its primary hub for, scale and efficiency, they've built verified supply chains across multiple markets, like Vietnam, Cambodia, Indonesia, and Mexico. It's all about mitigating risk and ensuring product continuity, a deliberate strategy to reduce over-reliance on just one region.
And it sounds like they're not just diversifying countries, but also capabilities. They've invested in duplicate tooling initiatives in various regions,
Yeah.
which essentially means they're able to manufacture the same top-selling SKUs in multiple territories.
Yeah.
Gives them flexibility, operational readiness to shift production where it makes the most sense, practically and economically. However, executives noted that tariff fluctuations have made this challenging. New tariffs have popped up in alternative locations, sometimes negating the intended cost savings. It's like playing a global game of whack-a-mole with tariffs, isn't it?
That's a great analogy, actually. Yeah. And this raises an important question. How are they planning for the future, given this moving target? Well, the leadership team is moving forward with the expectation that tariffs are basically the new norm.
Wow.
Yeah. They are planning for 2026 and 2027 with current tariff levels baked in, focusing on cost reductions for legacy items and maintaining target margins for new products. They're not just waiting for conditions to change, they're actively adapting rather than, dwelling on the uncertainty.
That's a pretty bold stance for management to declare tariffs the new norm. But isn't there a risk that this sort of fixed mindset could limit their agility if the geopolitical landscape does shift unexpectedly?
It's a fair point. However, their diversified supply chain and those duplicate tooling initiatives actually give them that agility. They're not stuck with just one option. By planning as if tariffs are permanent, they're essentially baking those costs into their long-term strategy rather than reacting piecemeal.
Okay.
It allows them to focus on profitability within this new reality, which is, I think, a significant strategic shift.
Right. Despite the revenue dip and the operating loss, the company emphasized a much stronger financial position. Cash and equivalents, including restricted cash, surged to $43.1 million at quarter end. That's a significant jump from $17.9 million last year.
Big jump.
Now, by August, cash was down to $27 million due to customary payments, like to licensors, but is still a much healthier position than the previous year.
Definitely. And this focus on cash is king is clearly a central theme for management. They also completed a significant refinancing of their credit facility. They replaced an asset-based lending, or ABL agreement, with a new 5-year, $70 million cash flow revolver with BMO. That matures in 2030.
So what does that mean practically?
Well, it's a significant upgrade. Moving from debt secured by physical assets like inventory to debt secured by the company's projected cash flow. It reflects a much stronger vote of confidence from lenders and offers JKK's far more flexible working capital, which is key for a seasonal business like toys and costumes.
Got it. More flexibility. And in a notable move that signals confidence to shareholders, the board declared a quarterly dividend, $0.25 per share, payable September 30th to shareholders of record as of August 29th. Now, while that's certainly a positive signal, does it also maybe reflect an underlying concern about the stock price? Or is it purely a statement of their cash position, rewarding patient investors in a tough environment?
It's likely a combination, I think. The dividend certainly demonstrates confidence in their financial health and their ability to generate free cash flow, especially after strengthening the balance sheet. But yeah, it also acts as a tangible return to shareholders during a period of revenue uncertainty. Could potentially stabilize the stock and signal long-term commitment. It's kind of a multifaceted message. Inventory also increased to $71.8 million from $51.3 million year over year. About $17 million of that was in transit. But executives clarified this inventory build is primarily driven by international growth to support those expanding markets.
Yeah.
It's not really about higher import costs in the U.S. In fact, they're taking a very cautious approach to inventory planning, especially stateside, where inventory is actually down 8% year over year. They're prioritizing sell-through and cash generation there.
Makes sense. Looking ahead to the upcoming holiday season, JKKS certainly has a strong product pipeline on paper. They showcase new lines at San Diego Comic-Con, popular licensed IPs like Super Mario, The Simpsons, DC Exonic, Bendy, and Dogman.
Some big names there.
Yeah. New toys tying into the Sonic Racing's Crossworlds console game are also launching this fall. Other key initiatives include the launch of Disney Darlings, a new baby doll nurturing brand. It's available online now, planned for Q4 on shelves. International rollout planned for 2026. And the costume business, which saw significant cancellations when those tariffs spiked to, 145% in Q2?
Yeah, crazy numbers.
Has an optimistic outlook for 2026. They've got rights to Toy Story 5, the Disney Moana live-action film, and the new Disney Descendants film.
That could be a significant rebound if the costing situation clarifies.
Right, big if.
But the outlook for the U.S. holiday season remains cautious, uncertain. all due to ongoing tariff concerns and that shifting retailer behavior we talked about. Major U.S. customers are delaying their traditional second-half plan resets from August to early October.
Which means what exactly?
Well, it results in 2 fewer months on shelves for new fall product introductions, which means lower productivity is expected from the fall product line, just less time to sell.
Okay, so that delay in retailer resets means Halloween sales are probably going to set later this year.
Seems likely, yeah.
The leadership team anticipates that retailers will jump heavily into toys, but they'll be highly cautious. They said picking the toys that are selling through well and not taking any risks on really big TV advertised items. Instead, focusing on razor blade products, basically, items with an initial low-cost purchase that drive recurring sales of accessories or refills, and other items at a lower price point.
Yeah, that picking the toys that are selling through well approach is telling.
Definitely.
It underscores how much pressure brands are under to deliver immediate hits. Little room for experimentation or new IP that isn't already, pre-validated.
It's a tough retail environment.
Very. But management sees significant long-term opportunities actually arising from this current market turbulence. They noted that as other companies face financial issues, maybe due to tariffs and uncertainties, this environment actually encourages licensors to seek out financially stable partners, like JAKKS Pacific.
Oh, interesting.
That's a classic strong hand in a turbulent market scenario. They become a sort of port in the storm for others.
And building on that, the company is cautiously curious about M&A opportunities, which reflects their disciplined approach, being selective in picking up new, high-potential licensed brands and categories that can actually be profitable in this new tariff environment.
Yeah, this isn't just standard corporate speak, I think. It signals a unique opportunity. In a market where competitors are struggling with these same tariffs, JAKKS's financial stability positions them to potentially acquire valuable IP or market share at, distressed prices, not just buying for the sake of buying.
Right. Strategic opportunism. Okay, so recapping. You've heard the numbers, management strategy. A beat on adjusted EPS, strong margins, yet a notable revenue miss and an operating loss. The market reacted with, a fair degree of caution to this report. After hours, shares were down approximately 8% to around $19.01 following the release and call. Closed at $19.08 the next trading day. Trading volume was elevated, and the put-call volume ratio was notably high at 12.0. Suggests a decidedly bearish sentiment among options traders, at least initially.
Yeah, and this divergence between management's emphasis on financial resilience and that immediate negative market reaction. It indicates the market is heavily prioritizing the U.S. demand weakness and the unpredictable tariff landscape, more so than the demonstrated strengths in margins and liquidity, at least for now.
Right.
The underlying concerns likely center on the duration and impact of these trade frictions on future top-line growth, and when, or maybe if, the U.S. market will normalize. It's a real push and pull between short-term pain and potential long-term strategic positioning.
So what does this all mean for you, the listener, trying to understand this? The challenges faced by JAKKS Pacific aren't isolated. They reflect broader retailer caution and tariff-driven cost headwinds impacting the entire toy and costume sector. The delay in retailer resets shifts in consumer behavior towards lower-priced items that can set the tone for the whole industry's holiday season. It paints a picture of a very cautious consumer and retail environment. Makes you wonder, doesn't it? How many other companies are facing these exact same tariff dilemmas, scrambling to reroute their global supply chains?
Absolutely. It's a huge theme right now. And the company's strategic pivots, that robust international growth, the unwavering focus on cash generation and margin protection, the significant upgrade to its capital structure, these are crucial for navigating this environment. These steps could position them well for recovery, maybe even opportunistic growth, if and when U.S. market conditions stabilize. It really underscores the importance of a strong balance sheet and an agile supply chain in a volatile global economy, especially for companies dealing with international trade.
Okay, we've broken down the financials, the strategy, the market reaction. Now, for those looking to maybe translate these insights into a potential action, let's shift gears slightly. Let's consider a hypothetical investment approach for JAKKS. This is our not financial advice segment, remember?
Right. Disclaimer noted.
The market's giving us a bit of a mixed signal here, right? A knee-jerk drop post-earnings, but under the hood, there's this compelling narrative. A company battening down the hatches, building a cash war chest, positioning itself for long-term resilience.
Okay, so here's a wild yet, I think, plausible trade idea for those with a deeper understanding of options. Going long JKKS with a protective put ladder strategy.
All right, break that down. The rationale is what?
The rationale is this. Management is explicitly optimizing for cash and margin dollars, not just top-line revenue at any cost. That's fundamentally sound in a volatile market.
Makes sense.
They've successfully refinanced their debt, boosted liquidity to that $43 million mark initially, and they're maintaining a dividend. All strong signals of confidence.
And the international piece.
Soaring, yeah.
Yeah.
Up 40.9%, effectively offsetting some of that U.S. tariff-driven weakness. And critically, the company's leadership is actively exploring M&A. They're being approached by nervous licensors and struggling competitors. It's that classic strong hand in a weak market scenario again. Allows them to be opportunistic buyers, maybe consolidators, which could unlock significant value down the line.
Okay, so the hypothetical trade involves 3 steps. 1,
buying JK shares, long position. You're betting on the long-term strategic execution and eventual market recognition of their disciplined approach, and maybe potential opportunistic acquisitions. The current dip provides an entry point based on this long-term view.
Step 2, protection.
Step 2, purchasing out of the money puts, say, strike $17.50, expiring maybe 6-9 months out. This is your baseline protection against any unforeseen escalation of trade wars or a deeper than expected retail slump in the U.S. Limits your downside on the equity like an insurance policy.
Okay, and step 3, the latter part.
Step 3, selling further out of the money puts. For example, strike $15, same expiry. This is where it gets interesting. You sell these puts to partially offset the cost of your protective puts, essentially creating a put spread.
Ah, okay.
The market's current elevated options, implied volatility, might even allow for decent premium capture here. You're implicitly saying, okay, I want protection, but I don't expect the stock to absolutely crater past, say, $15, given the company's newfound financial flexibility and management's proactive stance.
Got it. So this setup allows you to participate in potential upside while effectively managing the tail risk inherent in this tariff-sensitive industry.
Exactly. It's a nuanced play for a nuanced environment, trying to balance the known strategic strengths against the unknown macroeconomic headwinds.
Okay. So wrapping up, we've walked through JAKKS Pacific's Q2 2025 earnings. It painted a picture of a company skillfully navigating a truly challenging environment. Despite a revenue miss and an operating loss, management demonstrated strong execution on adjusted EPS, gross margins, and liquidity. Their strategic pivots toward robust international growth, proactive supply chain diversification, and that cash is king philosophy are clear, decisive responses to the U.S. market's tariff-induced uncertainties.
Yeah, the immediate market reaction definitely reflects ongoing concerns about U.S. demand and the broader macroeconomic climate. But for you, the learner, this raises a crucial question. In an era of increasing global trade frictions, unpredictable markets, how much weight should investors place on a company's financial resilience and adaptability, its ability to endure and pivot, versus its short-term revenue performance in a single challenged market?
That's the key question.
What strategic shifts do you see as most impactful here for the long term? We encourage you to continue exploring these dynamics.
Absolutely. And remember, this analysis is for informational purposes only. It is not financial advice. Always do your own due diligence before making any investment decisions. Thank you for joining us on the deep dive. We look forward to our next analysis.